Hello everyone, and welcome to this video blog edition of Jeff for Banks. I'm driving the long and lonely Turnpike Road from Pittsburgh across the state of Pennsylvania, from the great city of Pittsburgh, and the topic came up in my last meeting about product management. And I know that some financial institutions, not a whole lot of community financial institutions, but some do have the title or the functional responsibility of product manager. And I thought out loud, actually I tweeted it, how could you have the product management function in a financial institution without measuring product profitability? What exactly are you managing to? And one of my Twitter friends got back to me and said that a lot of folks manage by volume or number of accounts or new account acquisition and things of that nature. And I suppose those are fine metrics for campaigns and measuring the ROI of campaigns. But if I'm the product manager of, let's say, a home equity product, what am I doing on a day-to-day basis to make that product measure to what? I would assume to greater profitability. So therefore you would assume that profitability measurement would be a piece of it. And if you ran a campaign of home equities, the overall objective would be, yes, we're going to get $10 million more of new balances, but the overall home equity product will be more profitable if we're successful. That would be the judge of your measurement. So if you measure product profitability, however imperfect it may be, as long as you use the same set of assumptions and you track the trend of the product over time, then the answer you're getting is directionally correct. So what are the levers that you can press to improve the profitability of your product? Sticking with the home equity loan example, there's the spread that's delivered by the balance in the account, both in a ratio and a dollar basis. There's the fee income that you generate, and there's the cost of what it costs to run that product. In addition, there's the risk component. How much equity are you allocating to that home equity product based on risk? How much provision do you have to allow on a periodic basis for the pool of home equity loans under your charge? So there's spread, there's fees, there's cost, and there's risk. All of those components should be included in your product profitability. Spread, for example, the preferred method or the best use would be a coterminous funds transfer pricing spread, where the spread is calculated by taking the interest income from the product, right, and using a cost of funds that is a market instrument of similar duration. And the reason why you use that instead of, say, your institution's cost of funds is because if you do a great job at collecting funds in your branch network, why would you project that great job of collecting funds onto your home equity product? Also, it makes no distinction if you have a 15-year home equity loan or a 5-year amortizing home equity loan. The interest rate risk, it would actually behoove you to take on more interest rate risk in that environment because there's no penalty on the cost of funds side. But if you're using a coterminous funds transfer pricing mechanism, then your cost of funds would go up the longer you go out in duration. So in terms of calculating the spread, we would recommend using a coterminous funds transfer pricing mechanism. So therefore, if you go out longer, you have to get more yield because you're taking on more interest rate risk. So that would be one component of it. The second component is fees. Do you collect the fees to offset the cost? Say, for example, for the per account charge you get from your core processor. And I'm not talking about incremental fees. All of the resources that your institution dedicates to doing consumer lending, the underwriting, the loan servicing, the incremental fees from IT, are they accounted for can you offset them by collecting additional fees? So if you do free appraisals, for example, that would show up in the cost of doing a home equity loan, but there would be no offset on the fee side. So fees is one lever that you can press to improve the profitability of this home equity product. The third is cost. Much of the cost involved in doing home equity type lending, and most lending, for example, lean towards the origination side. So if you have low volume periods of doing any type of lending, the actual cost per account rises because most origination costs for financial institutions are fixed. You still pay the consumer lender, whether they do 10 loans in a month or whether they do 2 loans in a month, you pay them the same. So your costs tend to go up during low volume periods. So increasing volume tends to drive down a cost per account. Another lever that a product manager can press in order to improve the profitability of the product. The last lever is the risk component. So if you do a 100% loan to value home equity loan, that would be a riskier loan that might need, for example, a greater provision for loan loss, which would reduce the profitability of that product. Or it might require additional capital be allocated to that particular product, which would reduce your risk-adjusted return on capital, or RAROC. So if you have product profitability, you can look at your products that are under your charge more holistically than just doing volumes or number of accounts. It could be a more holistic look to improve the profitability of those products, which ultimately improves the profitability of your bank. Thanks for listening.